Hi, my name is David Halsey. I'm author of Trading the Measured Move and creator of eminiaddict.com. If you like the content of this video, click on the thumbs up button and subscribe for updates. If you would like a closer look at the slides in this presentation, follow the link in the description. Okay, ladies and gentlemen, we're doing a webinar on Bitcoin. And this is I guess you could say the continuation of a webinar that we had done here 3 years and about 11 months ago when we were exiting the crypto winter. And what we were, 3 years and 11 months ago, almost 4 years ago, we were projecting the bottom of the crypto winter and the beginning of this investment cycle that we're ending right now. And the first thing to understand, and of course this is not investment advice. It's important to understand that these are patterns in the past that we're projecting out into the future, and prior returns do not guarantee future returns in any way. But these are the cycles as they have been progressing into from the past and into the future. The first thing to understand here and to get some context is that there's a 4-year crypto cycle model, and there's winter patterns and market transitions. And the Bitcoin winter, it happens every 4 years, and it's followed by a crypto spring, which leads to a crypto summer, which is growth, to a crypto autumn, which is a peak, which we're entering now. The first crypto cycle, the first crypto winter, was November 30th, 2013. We're looking at this cycle right here. So Bitcoin traded in the autumn of 2009, and it was ending its very first 4-year cycle in November 30th of 2013. The price high was 1,163. Now, 13.5 months later, it made a market bottom on January 14th, 2015. And its price low was $152. That was the first crypto winter. And that was followed by the crypto spring, summer, and autumn. And that led us into the second crypto winter, which you can see here on the chart when I scroll forward in time here. So the 152, and then the next crypto winter we ran into was December 17th, 2017. The price high was 19,666. Now, 12 months later, it made a bottom of 3122. That's the bottom that you see here. 3,122. It took 12 months to fall in that crypto winter. From that crypto winter low at 3122, we went into our spring, summer, and fall, and that led us up to the beginning of the next crypto winter, the end of the crypto autumn, which was 69,000. That market top on November 10th, 2021 is the most recent top that we were projecting here in 2021. That was the 69,000. We topped off at 69,000, and 12.5 months later, the market bottom was created, November 21, at 15,479. And that is this low down here. And since that low, we have risen from the 15,000 to the 126,297. Now, is there any rhyme or reason around all of this? Absolutely. The key patterns, the winter duration is between 12 and 13.5 months. What's really interesting is that the crypto winter is very, very consistent as far as the decline goes. But the crypto autumn, it has about, as you can see, about a 45-day variance there. It's about a 45-day variance. It's 12 to 13.5 months on average. The crypto winter typically lasts about 1 year from peak to bottom. The peak timing is between November and December. Market tops consistently occur in late quarter Q4 of the crypto autumn, which we're in, with winters forming during the holiday season and then going into the next year. The full cycle is a total of 4 years. The complete cycle from one winter peak to the next averages around 1,451 days. So we're currently analyzing the fourth cycle. When will the next crypto winter begin? The 4-year cycle analysis and prediction. Historical cycle lengths, the first cycle was at 1,478 days, so 4.05 years. The second cycle was 1,424 days, or 3.9 years. The third cycle was 1,451 days, so 3.98 years. If we're taking the average of all of those previous cycles, the prediction for the next peak is October 30th, 2025. But the range is that around month and a half to month and 3/4 window between October 3rd and November 26th of 2025. So this part of the cycle is the hardest to risk manage around because there's been so many variations. What's important to understand, though, is that the current cycle progress of what we're the percentage of way that we're through this cycle, we're at 98.5% of the way through this cycle. We're at 98.5% of the way through this cycle. As of today, October 9th, 2025, we're already 98.5% through the average cycle, meaning that we could be entering or very near the peak of this cycle right now. How severe will the next crypto winter be? So this is a drawdown analysis. The predicted drawdown for cycle 4 is minus 73%, but it has a range between minus 71% and minus 75%. How do we come to that prediction? The historical drawdown trend in the first cycle was 86.93%. In cycle 2, the crypto winter fell 84.12%. And so it was 2.8% less severe. The third cycle, which we ended in 2022, the last end of the crypto winter, was 77.57%. So minus 6.55% less severe. And if we take that same prediction model and are predicting how bad a winter could be, how severe a winter could be. Again, winters, just like our regular winters, there are some severe winters, there are some mild winters. How mild or severe, based on this pattern, would the next crypto winter be? If we take that out into the future, the average reduction per cycle is 4.68%. So we don't yet know what our high is yet, right? And we won't know until we break trend. But if a peak was 100,000, the bottom would be 27. If a peak was 150, the bottom would be 41,000. If a peak was 200,000, it'd be 54,000. The key insight here is that we have a market that is maturing. The market appears to be maturing, retaining more value with each cycle. Value retention has improved from 13% in cycle 1 to a predicted 27% in cycle 4, suggesting decreased volatility as the asset class matures. This is a 4-year crypto cycle timeframe. This is the historical data from 2013 to 2025 and a projected path into the end of 2025 and then into 2028. You can see here that this whole cycle 1 peak here crypto winter, spring, summer, autumn, into the end of the autumn, and into the crypto winter. And then spring, summer, autumn, into the peak of crypto autumn, into the crypto winter, and then spring, summer, autumn. And we're projecting our cycle 4 peak now. The key observations here are there's a consistent 4-year cycle. Peaks occur approximately 1,451 days, and they're remarkably regular. There are decreasing drawdowns. Each winter shows a smaller percentage decline. 87%, 84%, 78%. And now, if we were projecting that out into the future, 73%. The winters are 12 months long. Bear markets typically last about 1 year from the peak to the bottom. The current position as of October 2025, we're 98.5% through the cycle, near a projected peak. This is a little bit different view of that 4-year crypto cycle timeline. And this one was done in a logarithmic scale. The second one is done in a linear scale. We look at charts in a linear way, but you can't see the big drawdowns here in a logarithmic chart. It's kind of deceiving. You can see the drawdowns inside of the linear scale. A linear versus a logarithmic scale, what you're seeing on a linear scale is that the early cycles, 2013 through 2017, appear almost flat at the bottom of the chart, while recent cycles dominate the visual space. But this can be misleading. Why it matters is the first cycle's move from $152 to $1,163 was a 665% gain. Actually more impressive than the cycle 3's move. But on this linear chart, the cycle 1 looks tiny versus the logarithmic looks big. So you're switching that time frame. So best for analysis, the logarithmic scale version shows the percentage changes more accurately in the beginning. You could say that the linear makes the scale more accurate in the present, if you want to think about it like that. Linears are better for showing absolute dollar values. So I just wanted to touch on that here because sometimes the charts look very strange. So if we're projecting out into the future, we're at the beginning of the crypto winter here, and we have all of these previous lows. You know what's really interesting too, just as a side note, is that the crypto winter lows have this tendency of being, much higher than the last crypto winter. And that's how, Bitcoin maximalists will justify hodling or holding on for dear life and never selling. Key observations on the linear scale. Exponential growth. Recent cycles show massive absolute dollar gains compared to early cycles. The early cycles are compressed. 2013 to 2018 the activity appears compressed at the bottom, making patterns harder to see. The dollar magnitude shows actual dollar amounts more intuitively than for recent price movements. And then the projected peak, 120,000 target clearly is visible as the highest point here. And we could continue to make new highs, certainly, but we cannot predict that. Here is a projection here. It's the same chart. The first chart was a projection, where we are now. Where is the bottom of the move if we didn't make another new high? If we're thinking about it from the perspective of the 73% down, the price would be 32,500. It's 73% down. If we're taking that same, projection out into the future. This slide covers declining returns across cycle phases, how the spring, summer, and autumn performance has changed. So in the first cycle, the spring return, you can see here, was plus 327.6% from the winter bottom to the spring end. So incredible. But notice here how in cycle 2, it was only plus 252.3. And in cycle 3, our current cycle, it was only plus 93.8. So it's declining over time. The summer return in the first crypto cycle was actually plus 46. The cycles in the summer are getting actually stronger in cycle 2 and remain that way. So plus 46, plus 154, plus 133. It's the autumn returns, though, that are, this is where it's dangerous to be, blindly long and complacent in the market. In cycle 1, the autumn return, plus 22. It's still a positive return, mind you. Okay. What about in cycle 2 in the autumn? Minus 29. What about in our current cycle? Minus 1.4. So the crypto autumn, we already start to see market participants who were participating at the end of the winter, the beginning of the spring, all throughout the spring, all throughout the summer, starting to take profit. I'm going to show you how that's happening, more than likely why that's happening, and we'll be able to. You can imagine here, they're buying the bottom of the dip in the dollar cost averaging in, but they're also taking profit on the way up. So the total uptrend from peak bottom to peak plus 665, plus 529, plus 345. So we have declining returns across this cycle phases. Okay, you can see the visual comparison here. You can see they're declining. Phase by phase, you can see here, this is just viewed a different way, plus 327, plus 252, 93. The summer phase, still spring and summer are the best times to be a buyer. Autumn is when you're thinking about, selling into the liquidity and, retail that is essentially chasing a rally. So the key pattern, diminishing returns, each cycle shows significantly lower total returns than the previous cycle. Cycle 1 delivered a massive 665% gain from the bottom to the peak, while cycle 3 only achieved 346. Still impressive, but nearly half the original performance. The spring phase shows the most dramatic decline, dropping from 328% returns in cycle 1 to just 94% in cycle 3. This suggests that the early recovery phase offers progressively smaller opportunities as the market matures. Interestingly, the summer gains have remained more consistent, with cycles 2 and 3 showing similarly strong performance, 154% and 133%. This may indicate that the mid-cycle growth phase remains robust even as the market matures. The key takeaways for investors are there's a lower absolute return, but it doesn't mean that there's no opportunity there. A 346% gain in cycle 3 is still exceptional by traditional market standards. We're talking about hundreds of percent gains. It's ridiculous, especially when you're talking to traditional market people, right? The spring phase declining the fastest. Early recovery periods offer less dramatic gains as market maturity increases. That's interesting. Even the spring phase is declining. The summer is the strongest. It remains strong. Mid-cycle growth phases have maintained robust performance across cycles. The market maturation trend is that cycles align with expectations as crypto becomes more established and institutional. And this is a cycle 4 projection. If the trend continues, expect the total returns in the 200 to 300% range. So we're at that point, aren't we? Here's a heat map, crypto cycle returns, a heat map analysis. So this is the same idea here, thinking about this from the perspective of where the gains are inside of the crypto cycle. So we have, and of course, in the first cycle, spring, summer, insanely powerful. And then we're declining in even the spring and summer. And then as we're moving along here, you can see here the autumn is getting less profitable as well too. So The spring and the summer, the end of the crypto winter, is still the best time to buy, but we do have to expect lower performance moving forward. You can see here the best performing phase, spring, cycle 2, cycle 3 was the summer. The worst performing phase of cycle 1, 2, and 3, autumn. Where are we? We're at the end of the autumn, aren't we? The most consistent phase, the summer average is 111%. The standard deviation, 49.7%. And of course, it's reliable from the pattern, the time analysis. The risk reward by phase, historical average. In the spring phase, buying in the spring, the average return is plus 224%. Volatility is high, right? The risk level is medium. And actually, think about this. From the numbers, it actually shows that the spring has a medium risk level because it has lower average returns. The summer phase, based on these last 3 cycles, is plus 111%, but its volatility is medium. It's actually more stable. The risk level is perceived as low because it has had higher returns, more consistent returns. And of course, the autumn phase, the average return is -3. In the autumn, we're talking about the whole year. The volatility is very high. It's a weakening trend. The risk level is very high. To be invested even in the 12 months prior to this, historically, which is not a good sign. It's not a good look for the crypto markets. And it's really interesting, isn't it, that market participants are chasing highs in the last part of the cycle. The spring strategy, while spring returns are declining 328% to 94%, they still offer solid opportunities. Early entry in the recovery phase, but expect more modest gains than previous cycles. Summer strategy. The summer has proven to be the most reliable phase with consistent 100+% returns across cycles 2 and 3. This is the sweet spot for risk-adjusted returns. Primary accumulation period. The best time to be in the market. Autumn strategy. Highest risk phase with negative returns in recent cycles. If we reach late October 2025, near projected peaks, consider profit taking rather than expecting a traditional blow-off top rally. That's what it would suggest. The markets wouldn't suggest a blow-off. So portfolio timing is based on the patterns. Accumulate heavy in the end of the winter and early spring, hold through the summer growth, and beginning scaling out in the autumn as volatility increases and returns typically to flat or declines. This is a dollar cost averaging versus lump sum analysis. So what is the optimal strategy across cycle phases? We are looking at the strategy comparison of historical performance. And if you were to be absolutely perfect, which it's never possible to be absolutely perfect. In first cycles, it was a plus 665%. Cycle 2, top to bottom, plus 530. Cycle 3, top to bottom, plus 346. Average return is plus 514. Obviously, it's impossible to do that. Nearly impossible. When you look at dollar cost averaging, and this is what we were talking about at the end of the last winter, the beginning of the last crypto spring 3 years ago, the PI period is around 12 to 18 months. The average entry price, it's minus 30 or 40%. The estimated cycle 1 return plus 450 to 500. Estimated cycle 2 plus 380 to 420. Estimated cycle 3 plus 240 to 280. And the risk level is low to medium. What happens if people are buying the all-time high at the peak? In cycle 1, 2, and 3. Minus 87, minus 84, minus 78. The recovery time is 4 years. It's incredibly dangerous to be buying at the end of the autumn and the beginning of the crypto winter, as you can see here, just by the numbers. So optimal entry points by phase. If we look at the entry strategy and we look at the phase here is along the left-hand side, the entry strategy is the next column. Then there's the risk level based on the average rate of return. And then the expected multiple. And then based on just what's worst and what's best from the perspective of, what to avoid versus what is optimal. The early winter, right, we're going into right now. So we're in the autumn right now. And maybe we should start from the bottom of this table here. We should be scaling out gradually. The risk level is high. We're near the peak. The expected multiple is almost nothing. If you're looking at the last, from the perspective of, all of our previous data, it's a time to be taking profit. So that is, a bad time to be in the market, long the market. And then we go into the early winter. Early winter, we wait and see if prices are falling or not. What's the risk level? It's very high right now. The risk is catching a falling knife. What is the expected multiple? It's unknown. It should, based on what we know, it should probably be negative, shouldn't it? We should be avoiding the crypto winter at all cost. So we get into late winter, and you could actually consider, beginning a dollar cost averaging, a DCA program with a medium risk level with a expectation of a 3 to 6x potential. That's when you would start late winter, late crypto winter, even the early spring. Again, now we had begun the dollar cost averaging. Now we're aggressively dollar cost averaging. 25% to start, 50% capital to get into our aggressive. The risk level is very low. You have 2.5 to 5x potential. This is the optimal time. We talked about this as we were coming into the beginning of the last crypto spring. Late spring, you could see this here as the final DCA, or dollar cost averaging, for the next 25% of the capital. Medium risk. The expected multiple is 2 to 3 times potential. Again, not optimal, but good. And then the summer, hold and accumulate on dips. And holding and accumulating on dips, when we started the crypto summer, we were talking about that at that point as being the time that we implement the collector strategy, where we are in a full position and we are using futures contracts to, if there are drawdowns, to use them to our advantage to dollar cost average into better prices and accumulate more crypto, more Bitcoin inside of the crypto winter. And there's a 1.5 to 2.5 times multiple potential. The summer is the hold. And then you get into the autumn, and again, we just came from there. It's best to scale out gradually, high, near the peak, because the gains aren't there. If we look at a real world scenario, say a $10,000 investment at the winter bottom, and say the entry price is the $15,479, we were there. That was when that first video was when that first video was made. And I have a peak price here of $69,000. Of course, we went almost double that. But you can see here the return, plus 346%. We went to 120, not 69. What if you dollar cost averages over 12 months? The average price would be not 15, but 22. And you can see here that the dollar cost average isn't as big of a gain, obviously. But you do have peace of mind, because it's very difficult to pick the exact bottom. Scenario C, what happens if you're just buying the peak? Obviously, you're having a 78% loss. That's where we are now. So winter entry, the downside risk in the first 12 months is extremely low. The spring entry, it's low to medium. The summer entry, it's medium. The autumn entry, extremely high. the drawdown risk in this next 12 months is minus 70 to 80%, historically speaking. The rule of diminishing returns. So this mathematical pattern on the diminishing returns inside of, essentially our gains are declining. So each cycle returns the previous cycle times 0.725% is what it actually comes down to. A historical analysis shows the returns decline by approximately 27.5% per cycle on average. This exponential decay pattern suggests Bitcoin is following a predictable curve that is as a market capitalization grows and institutional adoption increases. So this is historical versus projected returns. And you can see that 665, 530, 346%. In cycle 4, we'd expect 251. In cycle 5, 182%. In cycle 6, 132%, declining over time. And this just essentially goes over the decline in every single one of those cycles until, we get to in cycle 8 to 13, we might only be seeing a 69 to 15%. It's going to get smaller and smaller and smaller. So past to market maturity. If the exponential decay pattern continues, Bitcoin returns will gradually approach traditional market levels over the next 20 or 30 years. This is a natural progression as the asset class matures. Market cap grows and volatility decreases. So this is the key insights here are predictable patterns, the minus 27.5 decay rate per cycle. The expected, we still expect exceptional returns, even in the cycles from 2022 to 2033 to 2035. There's still 132% gain there inside of that cycle. Let's keep moving here. We're going to talk about portfolio rebalancing, and this is an idea, a thought experiment on progressively profit taking across the cycle. So as a strategy framework. The core principle here is rather than trying to time the exact peak, systematically reduce Bitcoin exposure as the cycle progresses through the summer and autumn phases. This captures the majority of gains while protecting capital from the inevitable winter drawdowns. The key is disciplined execution. Stick to the plan even when prices are rising. So this is why more than likely you will see the end of these crypto autumns and the beginning of the crypto winter. You'll see these kind of choppy highs, and you see it's profit taking. Market participants they were legging in the crypto end of the crypto winter, beginning of the crypto spring 3 years ago, and they're legging out on the way up, selling into the blow off top if there is one. Or in this case, there's not yet. So if we're thinking about this from the perspective of rebalancing a rebalancing schedule by phase, here's this cycle phase. There's a target allocation, the risk level, and then the action. Okay. So at the winter bottom, what's our target allocation? 100%. This is a maximum accumulation phase. In early spring, we're still at 100% Bitcoin. The risk is medium, low to medium. Continue holding, add on dips. Late spring, you might consider taking 10% off, 10% into stablecoins. The risk level is medium. First rebalancing, take 10% profits. Early Bitcoin summer, another 10% into stablecoins. Second rebalancing, you're selling another 10%. Late summer, another 15%. Third rebalancing, sell 15% more. Early autumn, again, selling 20% more. Peak late autumn, you're selling another 20% more. You're now 25% Bitcoin and only 75% stablecoins. And then as you've confirmed the winter's decline, you're basically in only 10% Bitcoin and 90% stablecoins. So a visual allocation progression would be in the Bitcoin winter and spring being 100% allocated to Bitcoin, and then progressively taking profits into stablecoins as we go into the Bitcoin autumn and the Bitcoin winter. And this is just shown to be progressive. Would you want to exit at all during the summer, knowing that that is the strongest part of the cycle? I think that you could argue against that. But this is just showing a nice even progression out of it. This is the psychological challenge. The hardest part of this strategy isn't the math, it's the execution. You'll be selling while prices are rising and everyone around you is buying. Your friends will brag about their unrealized gains while you're missing out, right? But when the crypto winter comes and prices crash 70 to 80% like they have in other previous crypto winters, you'll have the protected capital ready to buy the bottom while others are shell-shocked from losses. Discipline beats emotion every time. This is the second part of this portfolio rebalancing thought experiment. The results and practical guide. So a real-world example with a $10,000 investment, starting at Cycles 3's winter bottom of the 15,479 and following the rebalancing strategy through to the next winter. You can see here that raising cash along the way in late spring, early summer, late summer, early autumn, and then at the peak. You're essentially raising capital along the way. And here's the difference in the two comparisons. The HODL strategy, never sell. The value at the peak, you say it's 77,524. But what about the next winter? They experience a negative 73% drawdown. What about the rebalancing strategy? There was 5 rebalances. The value at peak might have been lower, but the value at in the next winter, the final return is plus 344%. And this is the strategy that most Bitcoin maximalists, i.e. Michael Saylors, will recommend. Just holding through all the drawdowns, diamond hands. As you can see, that doesn't make a whole lot of sense. So the rebalancing strategy outperformance is plus 112%. It's better returns than the HODL when measured at the next cycle's winter's bottom, obviously. 44,000 versus the 20,932 on a $10,000 investment. The tax efficient implementation tips, and this is really interesting as well too when you think about taxes. The hold for 1+ year is the goal, because long-term capital gains are 0 to 20%. They're far more favorable than the short-term 10 to 37. You want to plan your first rebalance after the first year mark. We can use tax advantage accounts, IRAs and 401ks that allow for rebalancing without triggering immediate tax events. The IRA iTrust is a very well-known crypto IRA. And, it's just like any other IRA. You just roll it right in and it's all crypto. All of the cryptos, most of them, are in that, and it allows for rebalancing without triggering those immediate tax events. Tax loss harvesting in the winter. If you hold Bitcoin through the winter decline, you can harvest those losses to offset gains from earlier sales. There's jurisdictional planning. Some countries have crypto to crypto tax exemptions at lower rates. Understanding your specific tax situation before executing is important. Stagger sales around tax years. If near year end, consider splitting a large rebalances to distribute tax liabilities across multiple years. And of course, document everything. Keep detailed records on all transactions, dates, prices, and amounts for accurate tax reporting. The implementation checklist for this is, before starting, define your target allocations. And we were talking about this at the beginning of the last crypto spring specifically. You have to decide, what portion of your portfolio is going to be exposed to, or what portion of your portfolio are you going to invest inside of the cryptocurrency markets. Understand your tax situation, choose stablecoins, USDC, USDT, Tether, DAI, set up exchange accounts and wallets. During the execution, stick to the plan, ignore the FOMO, fear of missing out, execute rebalances, use limit orders to reduce slippage, keep detailed transaction records, don't chase prices. Discipline wins. After each cycle, review the performance versus the holding on for dear life, HODL. Calculate realized gains for taxes, adjust strategies for the next cycle if needed. Hold stables through the crypto winter. Plan a re-entry for the next winter bottom, which is what we were talking about in that first video. This is the second part. The bottom line is this: in crypto, making money is easy, which is why everybody chases the highs. It's the keeping it that's hard. It's the keeping it that's hard. Because of these crypto winters, just they do a about face. They return to where everyone accumulated their last. The real value of Bitcoin is the value of the dips. Interestingly, if you think about it that way. The rebalancing strategy sacrifices the dream of selling at the exact top in exchange for the reality of consistent protected gains. Most investors who hodl through a full cycle end up with modest returns after surviving the drawdown. Those who rebalance systematically outperform by hundreds of % over the complete cycle. Remember that bulls make money, bears make money, but pigs get slaughtered. This is a multi-cycle portfolio model, and I just want to show you, we were thinking out into, the 2030s, and we're going into our fourth cycle now, but there's going to be 7 cycles and 8 cycles. This is going to keep on going with less returns over time. But this is an example with the benefit, of course, of hindsight, of the power of patience. Okay? In the past, and the power of patience, what it will lead to in the future. This is the power of patience across 10 years and 3 complete cycles, going into our fourth now. If you invested $10,000 at cycle 1, winter bottom, at $152, you hold through cycles 1, 2, and 3, ending at the projected cycle 4 winter bottom in 2026 at $32,400. The total time frame is 10 years. What is the hodl forever strategy do? 2.1 million. What is the perfect timing? 2.1. What is the rebalancing? 2.5. What's the DCA at every bottom? 2.1. Is there a benefit to the cycle by cycle breakdown from the hodl perspective? It might be if you didn't have the tax advantages. But it's very difficult to go through those cycles and have 73% drawdowns. Absolutely. You can see here that the difference between the harvest, the projected 4-year winter bottom here, 2.545 through all of those cycles was just a $10,000 investment. This is a compound annual growth rate, CAGR. What does HODL forever do? 88. What's a rebalancing? This is a 10-year annualized return per year so far. Rebalancing gives a 94.6% return versus HODL Forever 88.6. The surprising winner is the rebalancing strategy. It outperforms even perfect timing because it compounds gains more effectively by taking 70% profits at each peak and redeploying at each bottom. You're working with progressively larger capital bases while maintaining upside exposure. HODL sounds simple, but enduring 3 minus 80% plus drawdowns takes iron discipline. Most investors panic sell during the winter, locking in losses. The rebalancing approach removes emotion by providing a systematic framework. Perfect timing is a fantasy. Maybe not completely, but nobody can buy the exact bottom and sells the exact top consistently. The rebalancing strategy gives you 80 to 90% of the perfect timings gains with far less precision required. So the key takeaways here: the time of the market beats timing. All strategies produce life-changing returns over 10 years. The key was staying invested through multiple cycles. Rebalancing wins. Systematic profit taking at peaks and rebuying at bottoms beat both pure HODL and attempts at perfect timing. At 10K to 2.5 million is actually realistic based on what had happened here. It's a 25,000% return over a decade. It happened for disciplined investors who executed a simple strategy. Drawdowns are the cost of admission. Every strategy except perfect timing endured brutal 70 to 80% declines. Mental toughness is required. Early cycles mattered most. Cycle 1 was the foundation. Getting in early and holding through multiple cycles compounds exponentially. And the pattern continues. If cycle 4 follows this historical pattern, then there's still time to catch the next wave, though returns will be smaller than previous cycles. The bottom line is, if $10,000 was invested in 2015, it'd be 2.5 million in 2026. That's the power of holding through multiple cycles with a disciplined rebalancing strategy. The next 10 years will not produce the same returns, but the principles remain. Patience, discipline, and a systematic execution beats speculation every time. That is the end of this presentation. I hope it finds you well. If you have made it to the end of this webinar, congratulations, because these are hard to. There's a lot of information to go through. But if you know anyone that would appreciate this information, share it with them. Thanks all.